Hello everyone and welcome to your Glassnode video report for the week on chain week 34. I'm your host Checkmate and we're recording this on the 24th of August 2021. So this week we looked at a number of different elements as Bitcoin really pushes up into that $50,000 range. So we've seen a number of weeks of very strong price action, and this is in the face of a number of elements we're looking at, such as elevated open interest in derivatives. We're also looking at some of the distribution that's going on. So there are people who are taking profits. There are investors and traders who are taking profits into market strength, and we're still seeing the market rallying higher. So what we're really looking at this week is just understanding what's going on in derivatives markets, where a lot of short-term volatility can come from when open interest climbs to very high levels. We're also going to look at some of the net balance on exchanges and just some of the flows and what's going on over the last week in terms of coins moving in or out of exchanges. We're going to look at the profits that are being realized on chain and some of that spending behavior to really dissect and understand what different cohorts of people are doing. So we're looking at the different classifications of traders, how old their coins are, what kind of profits are being realized, and where the losses are being realized. Just get a bit of a picture on what's going on in terms of the spending behavior. And really what that's boiling down to is an analysis of investor cohorts. So we're looking at people who have held their coins for long periods of time and therefore are quite experienced in this market. They've seen volatility, they generally represent the smart money, and they've had their coins in a dormant state for some time. And we're really going to compare that to what's going on in terms of the traders. So people who are moving their coins around on a much more frequent basis and looking at how those two different cohorts and their supply dynamics really affect each other over time. So let's jump into Glassnode Studio. We'll have a look at our week on chain dashboard and get started with our analysis. So here we are in Glassnode Studio. We're looking at our week on chain 34 dashboard. And this has really been the fifth green week for Bitcoin. We've seen a very, very strong rally from that $29,000 bottom that was put in at the end of July. And almost the entirety of August has been in an upwards trajectory. So this week we traded up from about $44,000 to just shy of $50,000. And actually as the week closed, we actually did get above that $50,000 level. And what we've seen over the course of this week, as we have this strong price action, we're starting to see leverage creeping up in the futures markets. And this is also the case for options markets. So within derivatives, what we're generally looking for is when there's too much leverage being built up on one side. So when lots of traders are taking on leverage, it generally signals that there could be a potential for either a long or a short squeeze, which really cascades some of that liquidations. It starts to push some of that leverage out of the system. So when too many people are trading in one direction and there's too many open interest contracts, it can start to create some kind of a squeeze. So what we have to look at here is two things. One, we have open interest, and open interest is showing how many contracts are open in our futures markets and how many contracts open in our options markets. Now we have to remember that when we're looking at institutional products and derivatives products, what we're really looking at is a combination of speculation with leverage, but also tools that are used for hedging. So some of this can be actually quite healthy leverage where people are actually using it to hedge out risk and use futures and options to really take some of the risk out of their trade situation. We can actually reduce overall volatility. Now, this is where we turn to our funding rate. So our funding rate provides us an indication of which side the market is leaning to. So when we have open interest, for every buy contract, there's also somebody who's selling and vice versa. So it's a 50-50 split between the buyers and the sellers to create this open interest. So just having an uptick in open interest alone doesn't necessarily tell us anything about the directionality of what could happen. Now, if we observe what happened through Q1 and Q2 of this year, we saw a very, very high positive funding rate. And what this means is that people who are going long on leveraged futures products are paying an interest rate to people who are going short. So it's creating that incentive for people to actually take the other side of the trade. And you can see the magnitude of positive funding here is really suggesting that a very, very large amount of people were going leverage long, and it suggests that there's a lot of traders who may have a short stop on the other side. So if price starts to fall, we can then get this cascading liquidation and also just stop runs where people have to exit their position as the market moves against them. Now, we saw the opposite come into play as we traded down in the sell-off in mid-May. We saw a very, very deep negative funding rate. This again is showing that a lot of people had gone short, and therefore the probability was that it was going to spring back in the other direction, and we saw a bounce from there. Through all of the period from mid-May all the way through to late July, we saw generally negative sentiment. More people were on the short side of the trade, and that has since reverted to the upside. Now, what's important is that we've got a positive funding rate, which has been maintained through the majority of August. However, note the magnitude of how positive it actually is. It really pales in comparison to what we saw during the full bull. So it's not necessarily telling us that there's a huge amount of directional bias. It's saying that in general, the market is leaning net positive. But alongside a positive price action, that's not necessarily telling us that there's a high probability of a huge short squeeze or a long squeeze in either direction. So at the moment, it is leaning positive. That would otherwise say that the market has more potential to actually liquidate some of those long traders and trade to the downside. But right now, it's not necessarily showing us anything that's too extreme. It actually compares to what we saw similar to late stage 2020. So at the moment, there's no huge directional bias based on our open interest and on our funding rate, although it is important just to be aware that we do have climbing open interest, which can show a bit of interest. There's more people coming into the market and trading it, and potentially that could become a squeeze at some point in the future. But for now, there's not necessarily a very strong bias in either direction. Now, if we look at our balance of coins and our flow in and out of exchanges, now the idea with exchange balances and the flow in and out is that ultimately what we would like to see for positive price action is more people taking self-custody, coins flowing out of exchanges, and that thus creates somewhat of a supply squeeze. There's fewer coins available and price is therefore the only thing that can move. Now, the converse is obviously true. If we're seeing an inflow of coins, it's showing that more and more people are then spending them, sending those coins to an exchange and creating more sell side pressure. And whilst the market can always consume through that and actually chew through that extra supply, it can take time to get through. And we saw during the entirety of 2020 and then into 2021, we saw a very, very substantial outflow driven by a number of factors: GBTC, general interest, the bull market that followed after March 2020. There was a number of factors that really started pulling those coins out of exchange. We then saw around 140,000 flow in during the sell-off in May. And then we really plateaued for a number of months and have since seen a large portion of those coins actually get withdrawn back out again. So we've more or less reset to a large extent most of the inflows that we've seen. Now, it's important to note that recently we've seen a slight uptick, and this really comes to speak to a number of metrics that we'll look at shortly. We can see that there are some coins coming into exchanges. If we look at our net transfer volume, we can see that after a period of net outflows alongside positive price action over the last month, we've actually seen some moderate inflows. So this doesn't necessarily mean that it's a negative trend, but it does say that perhaps there's something to just be cautious of and just be aware that there is now some sell side supply that appears to be coming into the exchange. So that's part of the story. We've established that there are some coins that are flowing in. There's clearly some people are selling. And what does make sense is that after a fairly substantial rally higher, some people will start taking profits. So it does make sense that there'll be both traders and investors. Some of them will be de-risking because they've seen a 50% drawdown fall away from their cost basis. Some people actually just want to exit after the price rallies back to their entry point. Some traders will have bought the dip and are actually taking out some profits. Some people may well be long-term investors who are just taking some cash off the table. There's multiple reasons why people would take profits. But what we can ultimately see here, and we try to look at this objectively, we do have coins flowing into the exchanges recently, although in the grand scheme of things, it's not huge, but it's just something we have to be aware of. And this is where we can now look at the cohorts of people and the types of spending that's going on. What's the source of these coins? Where are they coming from? So at the top here, we have realized profit and realized loss. So just to start, let's discuss what realized means. What we look at in on-chain analysis is the realized value of a coin. So if somebody moved their coin last and withdrew it from an exchange at $10,000, that coin will maintain that realized value of the coin value. Say it's 1 BTC, multiplied by $10,000, it will have a realized value of 10,000. If price has now rallied up to 50,000 and somebody spends that coin, it's now getting revalued from that 10,000 level where it was previously stored. It's now been spent and revalued at 50,000. And the underlying assumption there is that the person who is spending that coin is realizing profits on it and that coin is then changing hands. So what that now means is that for every buyer, there's a seller, and for every seller, there's a buyer. So those $50,000 worth of BTC, they have been revalued at 50,000. Somebody has stepped in and taken over those coins. So the assumption is that there's a capital inflow. The market has been able to absorb that sell side pressure, particularly as price rallies. So now let's look at our realized profit and our realized loss combination. So let's actually start with our losses. what we can see is that during the May sell-off, we saw a dramatic uptick in realized losses. These are people who accumulated their coins up in this $50,000, $60,000 range. As the price fell down 50%, many of those holders panicked, sold, and capitulated out of the market. And we saw a number of spikes all the way down during this correction. So people were realizing losses, spending coins they purchased higher, down at cheaper prices, and thus locking in those losses. Now, what we've seen is that since that point, we've actually seen a fairly substantial decline. We're seeing fewer and fewer coins being spent at a loss. And one easy explanation for this is that many of the holders who essentially bought up here, they did in fact sell. And those who remain in the market are either sticking around for the long haul, they're actually going to hang on to their coins, or perhaps as price rallies closer back up to their cost basis, now that we're up at the $50,000 level, perhaps they were buyers here at 50,000 who are now exiting. They purchased their coin at 50,000. Maybe they're spending it at 49, looking at a very small loss, but just trying to exit and getting their cost basis back. That could be one source of why the realized loss is continuing to decline. It can also be because people are willing to just hodl through the volatility and they've now become stronger hands. They're willing to weather that longer term trade. Now, the opposite is almost true for the realized profit. As price fell in May, we actually saw profits realized falling. So what this is showing is that people who purchased their coins at 5,000, 10,000, 15,000, any price where there's actually a profit to be realized, they actually stopped spending their coins during this correction. And that kind of suggests the opposite, showing that there was conviction to hold through the volatility at all times. And many of those people who are long-term holders, who've held their coins for a long time, they are experienced traders, they're experienced investors, and they're hodlers. They're people who are willing to actually hold through the volatility, and perhaps that 50% sell-off didn't actually shake them out of their position. So there's two different stories that we can see here. And what we can also note is that during the rally higher, more people are actually realizing profits and fewer people are realizing losses. So what this is partially going to be a part of is some people are going to be realizing profits just because they bought the dip down there at 29,000 and they're actually taking some off the table. Some of these will be traders who are actually spending their coins and taking those profits. Now, what we can also look at is our spent output age bands. This is one of these essential metrics that really understands which cohorts are spending based on the age of their coins. So anybody who purchased recently down at that $29,000, $30,000 price level, they would have held relatively young coins. They're maybe 1-2 months old. They're not overly old. Now, what we're seeing with our spent output age bands in particular, we're looking for these spikes of purple and these darker colors. Let's actually zoom into our year to date so we can get a clearer picture of this. So what we see with these darker colors, these purples, is really multi-year old coins. So the older they are, the young coins will be yellows and multi-year-old coins will be these darker purples. And what we can see is that over the last couple of weeks in particular, as prices rallied closer to 50,000, more of these older coins are starting to come back to life. Now, it doesn't necessarily mean that we're seeing a mass exit of these sellers. What we're seeing is just some of those profits are being taken off the table from some of those older coins. Now, we can see that the realized profit is certainly nothing like what we saw during the bull run as we came up to our peak up here at 50, 60,000. It's certainly quite muted. It looks somewhat similar to what we saw in the early phase of the bull market as we rallied from 10,000 to 20,000. So it's actually not too dissimilar to that. We're not seeing a mass exit. There's not a huge volume of coins, but we are seeing some of these relatively old coins. Perhaps they're de-risking, perhaps they're taking some profits, or perhaps they're just getting some dry powder in case they believe there'll be a sell-off and they can then step in and buy that dip. There's many different logical reasons as to why these coins will be coming back to life. And really what we're building up here is a picture just to say this is what's happening. We can then construct a thesis using all of these pieces of information to understand what's going on. And we can now move and look at our spent output lifespan. So this is the components that make up our spent output age bands, but broken down into our 6 to 12 month, 1 to 2 year, 2 to 3 year, and 3 to 5 year. Now, the reason that we've selected these particular age brackets is when they're older than 6 months, when a coin has been dormant for longer than 6 months, the probability of it being spent actually diminishes quite significantly. We see a great number of these coins move into a dormant state and actually stay there for a number of years. Coins that are younger than 6 months tend to be more day-to-day transactions. Someone's recently withdrawn it, there's volatility either to the upside or the downside, and they realize the profits or the losses. They're more likely to be spent, and the longer that they're dormant, the more likely they are to stay dormant. So what this shows us when we're looking at coins that are between 6 months and 5 years, these are experienced market participants. They're people who have seen volatility before. They probably understand quite a bit about how Bitcoin works and how the market structure and dynamics work. And what we're seeing here is what is the likelihood of them spending their coins. And if we note that during this rally through August, on all of these different age brackets, we've actually seen an uptick on a 14-day basis. We've seen an uptick in all of these outputs. Now we can see that for the 3 to 5, the 2 to 3, and the 1 to 2 year, it's actually relatively significant. So relative to what we've seen in the past, there's a larger number of these coins on the move at the moment. So it's showing that we're really confirming that there are some of those older coins coming back to life. They are coming out of what would otherwise be considered an illiquid state and being spent to now become liquid. So some of those seem to be the culprits that are flowing into exchanges, but then we also note that the amount that flowed into the exchange wasn't a huge break of that trend to the upside. It's something that we're aware of, it's something that we're just watching, and it's a trend that if it starts to develop further, that's when we can start to build a longer term thesis about it. On the 6 to 12 months, it's an uptick, but you can see it's kind of in line with similar volatility to what we've seen throughout this bull market. So we are seeing coins going into an exchange. They seem to be somewhat older coins. And what we're just looking for now is what is the probability of that creating perhaps some kind of local top. If the market can continue to actually consume that supply, then that's a strong sign. If the price keeps trending higher, it means that that sell side pressure is being absorbed by the market and we carry on. In the other instance, it could be that those coins come into the exchanges, they start to form a bit more sell pressure and perhaps put in a shorter term local top or just provide some kind of consolidation ceiling. So we're looking at these different combinations of what could happen using the data that's available. If we look at our average output lifespan on both the standard and entity adjusted basis, this really comprises all of what we've just talked about in terms of spend output ages. It looks at what's the average age of the coins. And what we're really seeing is that we're seeing a reasonable uptick, and you could almost argue that this is now forming a trend. So we're seeing an uptrend on both of these versions of ASOL, which is suggesting that as the rally powers on, as prices continue to rally through August, we're seeing more and more and more of these older coins coming in. And that's now becoming a trend that we should be paying more attention to because it's no longer just a single data point. We are starting to see that the average age of coins being spent is picking up. And what does that now mean for liquid supply? That's something that we can pay attention to. And we can then confirm this on our realized cap hodl waves. So this is the coin supply broken up into the different age brackets. Warmer colors, these red colors are young coins, and the cooler colors are older coins. So what happens and what's important to note here, we've seen this decline, which we've talked about over the last couple of weeks, this decline in these younger coin bands is trending down. And that's showing that coins are going from young to become old. There's a maturity process and a dormancy that's in the network. Note that in the last couple of weeks, as prices rallied higher, we've actually seen a slight growth in these younger coin bands. And what that's suggesting is that older coins are being spent, they're being reclassified as young coins and swelling up that volume. Now, also note that you can see that it's not a huge swelling in terms of size. So the thing to really take away from all of this, it maps onto our exchange balances. We are seeing older coins moving, but overall the amount of volume, the amount of coin volume that they're actually transacting is not overly large. So it's showing that potentially this is more of a strategic de-risking. Maybe it's traders taking out some dry powder. Maybe it's people who are exiting because they need for life expenses. There are many reasons behind this. But what we're seeing is that there are coins being spent. They typically seem to be older coins, but they're also not of a dramatic volume. Now, again, if this starts to really reverse and become a much larger trend, and we see, for example, it start to swell up like we saw during the bull market rally, that would start to suggest that maybe more and more of this coin volume is coming onto the market. So it's one of those things that we just pay attention to. We're seeing this trend developing, and we can start then establishing where we go from here. And the last thing to look at is quite an interesting divergence. And this is a big picture view on the overall activity on chain. So we've got here our number of transactions, our transfer volume, and what we can really see is a very, very slow, in terms of transactions on chain, there's very, very few transactions going on at the moment. And in terms of change adjusted volume, you can see that we're actually quite a bit below where we were at the highs. We're much higher than where we were during the 2020 pre-bull phase. And we're kind of where we were back here in January, February of 2021. So the overall transaction volume has risen a little bit, fallen back down, which our transaction counts are relatively quiet. So overall, the on-chain activity is quite slow, which, as you can see during a bull market, typically our transaction volume will climb alongside a rally higher. We've seen this to an extent, but it has started to pull back a little bit. So it's showing that overall in the on-chain activity space, it's relatively quiet, even though we've rallied from 30,000 up to 50,000. However, when we look at our long-term holder supply, so these are coins that are older than 5 months, coins that have crossed into that long-term holder threshold. So even though we have very, very quiet on-chain activity, we're still seeing a dramatic level of hodling. So a huge volume of coins. We've now seen a complete recovery back to all-time high of supply owned by these long-term holders. So on a macro scale, remember that these supply metrics tend to be longer range indicators. We're looking at things that could happen in the future. What is the overall supply flow through the system? Overall, this is a very positive trend. It's showing that people are willing to hang on to their coins and that a huge amount of accumulation has now crossed over that 5-month threshold, which makes it more and more likely that it will remain dormant. But at the same time, we have a divergence where we have very, very low on-chain activity relative to a rising price. So when we combine all of these features together, what we're building up is a picture of how is supply flowing through the network. There's clearly a base layer of hodling that's going on. People are hanging on to their coins and continuing to accumulate. We still have a fairly slow network. What does that really tell us about the utilization of Bitcoin as a protocol? And at the same time, we're seeing some of these older coins being spent, but not necessarily in a dramatically large volume. So it doesn't necessarily look like a mass exit or a loss of conviction, but it looks more like strategic de-risking or just some profit taking to really capture that volatility. And as the Bitcoin gets larger and more institutions and funds step into this space, more of this trading behavior is creeping in. So we're starting to see that it's becoming financialized, and there is more of this trading activity and day-to-day movements of coins, irrespective of how old they are. So that's a good summary for the week 34. Thanks for tuning in. Make sure you give us a rate, review, and a subscribe on YouTube, and we look forward to seeing you in the next one. Cheers.